Okay, in the previous video, we introduced one of the first multi-factor models. This was the Chen, Roll, and Ross model of 1986. Some of the some of the systematic risk factors that were included were macroeconomic variables, such as industrial production, expected and unexpected inflation, the bond risk premium, and the term structure of interest rates. Okay. What we're going to do now is we're going to introduce another model that has been more used than the Chen, Roll, and Ross model. I'm not exactly sure why, other than it might be tradition. I'm going to try to give this model some theoretical justification, but it seems like there's less theoretical justification for this model than there was for the Chen, Roll, and Ross model in the last video. However, this is the Fama French three-factor model. Okay, if I of course, if I just hide this right here, if I hide that right there, that just looks like the CAP-M, right? So what the Fama French three-factor model did was added two additional risk factors. The risk factor is called SMB. I'll explain what that is here in just a second. And the third risk factor is called HML. SMB stands for small minus big, okay? And HML stands for high minus low. Let me explain what that means. The small minus big risk factor is capturing the returns of small cap stocks minus the returns of large cap stocks. Does that make sense? I'll explain that here in just a second if it's not clear. The HML risk factor represents stocks with high book to market ratios minus stocks with low book to market ratios. All right. So what we're doing is, I'm sorry, I said stocks with high book to market ratios. What I mean is the returns of stocks with high book to market ratios minus the returns of stocks with low book to market ratios. I'll explain exactly how these things are calculated. But before I do, let me give you some justification for using these variables as risk factors. Okay. First, let me provide you some information here that might be useful. This is a graph. I've probably showed this in class from 1925 till 2007. This is an old graph. Sorry, I should probably update this, but whatever. The blue line represents if you had invested in the S&P 500, or at least the 500 largest stocks, in 1925, you invested $1. What would that be worth in 2007? Likewise, if you had invested $1 in this purple line, which is the S&P 600 or the 600 smallest stocks, what would that $1 be worth? And notice, first of all, that large cap stocks have done well over this 80-year period, right? The S&P 500 has averaged about 12% over this 80-year period. These small stocks, the S&P 600 has averaged 17.4%. Okay, so in other words, small cap stocks have outperformed large cap stocks historically. All right, and there's a lot of reasons that we could argue for why that is the case. First of all, you can see that small cap stocks seem to be more volatile. If you notice that purple line seems to have larger price movements than the blue line. Okay, so certainly small cap stocks are more volatile, meaning that they're probably more risky somehow. What makes them more risky? Well, they're probably startup companies, right? They're smaller stocks. They're high growth companies. They're taking more risks earlier on, trying to grow, and so that might be contributing to this volatility. But at a very minimum, we should understand that small cap stocks appear to be more risky in terms of volatility than large cap stocks. We don't really need to identify why that is, okay? But that's important. Let me show you something else here. Here's a research paper by Fama and French in 1992. This is before they introduced the Fama French three-factor model. And let me show you what they find here. What they do is they estimate a regression where they look at returns. Have I missed it here? Sorry. Here we are. They look at returns on the left-hand side. So here are stock returns next year over the left-hand side. And on the right-hand side, you have beta. Okay, this is the CAP-M beta. You have the natural log of the market value of equity of the firm. You can think of that as the market value, the natural log of market cap. You have the natural log of the book value to the equity value. This is book to market ratios. Okay. Book to market ratios. Here's asset to market ratios. Here's asset to book ratios, and here's earnings to price ratios. Okay, so they use this and they estimate a whole bunch of different regressions. So what they're trying to do is find out which stock specific factors influence future returns. First, the CAPM doesn't appear to hold. In a previous video in the last chapter, chapter 9, we tested whether or not the CAPM would hold, and one of the ways that we would test whether or not the CAPM would hold is if beta predicted positive future returns. We don't see that at all. These are T statistics in parentheses, and if they're not 2 in absolute value or above, then these coefficients are effectively 0. Something else here that I think is interesting. Look, small cap stocks, right? Market cap, if you take the natural log of market cap, that is a negative predictor of future returns for the stock, suggesting that small cap stocks typically outperform large cap stocks. Okay. Notice here, I take the natural log of the book to market ratio, and stocks with high book to market ratios, look, the coefficient on that is positive, suggesting that stocks with high book to market ratios have larger future returns than stocks with smaller book to market ratios. Again, this is suggesting that book to market ratios are important predictors of future stock returns. Okay. And even over here, the earnings to price ratio. Okay, we usually in our day and age talk about this as the price earnings ratio, but the earnings to price ratio also is a positive predictor, at least in some specifications. Okay. So this says something. First of all, market cap appears to be negatively associated with future stock prices, and book to market ratios seem to be positively associated with future stock prices. Okay. So what this means, let me try to provide you with some justification for including this. This small minus big factor, which is calculated in the following way. Basically what they did is they sorted stocks into 10 portfolios based on market cap. Okay, so portfolio 1 would be small cap stocks, portfolio 10 would be large cap stocks. Then they took the returns for the small cap stocks and they subtracted the returns for the large cap stocks. I've already shown you 2 instances where it appears that small cap stocks tend to outperform large cap stocks, and so the SMB risk factor, notice there's no subscript I here. This is a risk factor that is the same for every stock. All this is it's telling us the returns for small cap stocks minus the returns for large cap stocks. Now, what Fama and French may have been doing, although they didn't say this in their original derivation of this model, what they may be doing to theoretically justify this is they may be going back here and they may be saying, look, small cap stocks outperform large cap stocks, and we can see that small cap stocks are more volatile than large cap stocks. We don't need to identify the risk associated with small cap stocks relative to large cap stocks. All we need to say is that the market is smart. Right? And the market is pricing in the risks of these small cap stocks better than we can identify the risk in those small cap stocks. Does that make sense? So what they're doing is they're relying on this idea that markets are efficiently pricing in the risks associated with small market cap, and through the idea that markets are efficient, we can include the small minus big risk factor. We can include the small minus big risk factor as a systematic risk factor that captures the small minus big return premium. Likewise, the high minus low. We sort stocks into 10 portfolios based on high book to market ratios, portfolio 10, versus low book to market ratios, portfolio 1. We take the returns to stocks in the highest book to market ratio portfolio minus the returns to the smallest book to market ratio portfolio, and the difference in those returns is the high minus low return premium. Okay, this is the high minus low risk factor. Again, We don't know what's causing we don't know what's causing the book to market ratio that predicts future positive stock returns. We don't know what's causing the risk that's causing that return premium. All we know is that there is a return premium. And to the extent that markets are efficient, or markets can efficiently price the risk of the book to market ratio in the stocks, then all we're concerned about is this high minus low risk factor, which is the returns to the highest book to market ratios minus the returns to the lowest book to market ratios. All we care is that risk factor is capturing that risk. And under the assumption, under the theory of efficient markets, that markets are efficient, what we're saying is that any risk that's obtained in small cap stocks and any risk that's obtained in high book to market ratio stocks, this is going to be captured by these return premiums. Okay, so this is the Fama French three-factor model. Let's not lose sight of what we're going to do with this thing. We're going to assume that the CAPM plus the inclusion of the small minus big factor and the high minus low factor, we're going to assume that the inclusion of these factors, that we're properly accounting for all levels of systematic risk that exists in the world. And I know what you're saying. You're saying that's not possible. I understand that, but we're trying to get as closely as possible to capturing all of the systematic risk. To the extent that we do, when we subtract the risk-free rate from both sides, the alpha here that's highlighted should be equal to, I'm waiting for you to answer, but this is a video without any response, it should be equal to 0. So what we're going to do is we're going to estimate this model. We're going to assume that this model is doing a good job of capturing all of the systematic risk, and we're going to hold all of that systematic risk constant in our multi-factor model. And when we hold all that constant, any stock that generates a positive intercept, a positive alpha, are stocks that we want to buy and put into our portfolio. Any stock that generates a negative alpha, we want to stay away from, or we want to short that in our portfolio. Does that make sense? So this asset pricing model, this is it. This is where we're going to end the class. This asset pricing model is a way that we can use to estimate or to find alpha.